So today I'm going to do a video that someone suggested in the comment section a few weeks ago, and I thought, you know what, I'll save this towards the back end of the year and it'd be actually a really good video to make, which is some mistakes that I've made in the stock market this year, and I'm going to share them with you guys, and hopefully it helps you guys avoid making them mistakes. And also I think it's obviously really important for me to talk about these mistakes and help me improve as an investor, because as an investor you're always improving, you're always going to make mistakes. It's about learning from them and improving from them and making sure you don't do them again. And it's always going to happen whatever stage of investor you are at. You have to look at the likes of Warren Buffett, probably the best, greatest investor of all time. Even Warren Buffett still makes mistakes. I remember it in 2020 when he obviously was a lot of airline heavy in the stock market, and then the CV situation happened. He sold basically all of his airlines at 52 close, and within a few months all of them had doubled, tripled, quadrupled in share price, and everyone's looked at Warren Buffett and went, oh, he doesn't know what he's doing anymore, he's a terrible investor now. And it wasn't that he had just become a bad investor, he just made a mistake, and that happens to all of us, even Warren Buffett. And you look at his track record since then, and look at his track record, it's been absolutely fabulous. So yeah, we're just going to talk about this today, and these are 3 big mistakes that I feel like I made this year and hopefully can learn from them. So I hope you enjoy the video, and apologies it's a little bit later than normal. The reason why it's a little bit later is I was watching the World Cup, and what a fantastic World Cup final that was as well, by the way. But let's get stuck onto the mistakes that I made this year and what I can learn from them. So the first of all is buying in the same sector. So this is a rule. The worst thing about this for me personally is that it's a rule that I've always had. I've always had a rule not to buy stocks in the same sector. Now the thing is when it's a bull market or that sector's doing very well, you get away with it and both stocks fly, fantastic. But especially this year, you've had certain stocks that have been killed in that sector, and owning 2 of them has really harmed you. And an example for that is I've got 2 plant-based stocks. I'm sure you guys know which ones I'm on about, and because the plant-based sector has been not taken up, or there's not been much new consumers changing to the plant-based diet or reducing their plant-based diet, that's really affected them companies, and they've done really poorly, and the share price has done really poorly. It's same as like logistic heavy companies. In 2022 logistic heavy companies got absolutely slaughtered. I committed to Boohoo, and then I also committed to ASOS, and I thought that it was just going to be an ASOS problem, and then eventually they both got dragged down because of the logistic issues, and it killed both of them stocks. And in theory I should have only had exposure to one of those stocks, and that issue would have only affected one company. So that's something that I personally should have been following, a rule that I always had, and I kind of broke it a couple of times this year, and it came back to bite me a little bit. And yeah, I think that's just something to be cautious of, is be careful if you're buying in the same sector, because if the same sector or that sector gets hit by an issue, you're going to have 2 stocks that are dragged down, not just the one. And also for diversification reasons as well. There's no point building a stock portfolio of 10, 20, 30 stocks, and then you commit a heavy amount of stocks into the same sector, because you're not going to be diversified there. All of them are going to be dragged down, and that's something that I kind of got a reminder of this year, especially when you look at some of the sectors that have struggled because of the environment that we're in, with the inflationary pressures and logistic pressures that are out there. The second of 3 mistakes that I think I made this year is cut a dead stock faster. I think that obviously the difference this year being is that we've had a bear market, we've had the worst stock market in 14 years. So there's been stocks that are being punished incredibly hard, and probably would not have been punished as hard if we weren't in this kind of bear market. But there's been a few stocks that I have seen that have financially deteriorated that I've owned this year, and at some points I've done well to kind of cut them dead stocks, them stocks that aren't fundamentally improving this year, quite early on. But there's also a few stocks that I didn't do that with, or the worst case, or the worst thing that I could have done this year is I've seen stocks fundamentally stop improving, but then I've held them, or I potentially only trimmed a little bit and held some shares, and I should have just totally got rid of them. An example for this is there's 2 stocks that spring to mind straight away, which one of them was a UK stock, which was 888 Holdings. So I own this stock, I was up 200% on this stock, and I was very happy with the performance. Then out of nowhere, what happened is they made an acquisition of William Hill. William Hill, which basically got rid of the US assets, which are the best parts because that's a massive growth area, and just the UK and Europe assets. And a lot of that is tied to the physical locations. And I was looking at AAA and I was like, you're changing your whole business model here from online to physical locations. You don't have physical locations, they're absolutely dying. And then they overpaid for it, and then they took a load of debt on to do that acquisition. And it just totally didn't make sense to the business. And I was there going, this is a terrible acquisition, but I still held on to it even though I knew it was a bad acquisition, and the share price deteriorated. Now eventually I went, you know what, I do need to sell this because I haven't got confidence at all in this business. And I still walked away with a bit of a profit and some dividend. The problem is I could have walked away with plenty more profit than what I did if I reacted to what I saw that was worrying me, and I should have been quicker there. The same situation that happens with a TTCF, a stock that I started buying about 2 years ago. I held it for the first year and I thought they're actually doing really well, and I was happy to own the stock. And then there was a few mistakes made by the management team, and I was like, oh, I don't really trust this company, I don't want to buy it. And the share price was declining, and I was like, I've lost confidence. And I sold a good chunk of my position in TTCF, but I still held on to some of it. And what I should have done is gone, you know what, if you haven't got confidence to buy, and if you're having the issue now to hold it and you're selling some shares out, just get rid of all of it. And I would have avoided that stock being down a lot more than what it is right now. And I probably should have reacted that to a little bit faster than what I did. So those are two stocks, for example, where I was a little bit slow to react. And if at any point you do have that little bit of a worry in the business, in my opinion now, I look at that and go, sell it. There's a million stocks out there. You don't need to hold one stock that you're 80% sure on. Buy out of the million stocks that are out there, buy the 10, 20 stocks that you're 100% sure on. And that's what I should have done. The third one is fundamentals don't matter in a bear market. And this has been a brutal year. It's been a frustrating year because I talk about dead stocks and stocks that have fundamentally not been performing so well, and what has also deteriorated them a lot faster is the bear market, and the valuations had massively dropped. So you had to be very quick to react to them situations. This is total other end of the spectrum right now, is seeing this year in 2022, I've owned stocks that have fundamentally done fantastic in 2022. I have owned stocks that came into the year at $18 and are so much more of a bigger business now, an improved business, and it's still $18. And you're like, I've had my money tied in this for 12 months and it's done nothing, and it's frustrating. And in fact, there's a few stocks that I've owned, and I saw one stock I own that has, in my opinion, my best performing stock in 2022 financially. It's been absolutely brilliant. They've nearly put in 80-90% revenue growth. They're probably going to hit profit in this last quarter, and the share price went from $20, $10, $5. I think it even went down to $3 at one point. And it just shows you, I do think that maybe when it came at the start of the year, it might have been a little bit of a premium company, but I look at it and go, it's a premium company because it's absolutely smashing it. But I personally, for me, I didn't own that at $20. I started buying it at I think $7. But when I was buying it at $7 and then it went down 50% to $3, and it was like, that's unbelievable. The financials have just gone like that, and it loses half its value. And there's a few stocks, that I've owned that have been $10 at the start of the year, and they've done okay financially. They haven't done brilliant, but they've done okay. And then it goes down to $1, and it's been the reality check of how brutal bear markets, or this bear market, has been, and how low a bear market can price even a stock that's performing fundamentally amazing is brutal. When you go into a bear market, or in the stock market game, you can have stocks that lose 50, say 40, 30, 40, 50% of the value for no reason. That's the stock market. It's the brutal thing about the stock market. You can have a stock that's doing brilliant, and out of no reason, you can have a stock that loses half its value. But even though I've read this in Peter Lynch's books before, he said he bought stocks at $10 and then they've gone down to $2, even though the company's still doing amazing, and then you get the rewards because further down the line it does go back up to $20. But it's very hard to believe that. It's very hard to believe that the market is legit going to sell off a fantastic business that was $10 and it goes down to $2, and you have a stock that's losing 60, 70, 80, even dare I say 90% of its value. 90% of its value, when you look at the stock and go, but it's still doing okay. And it's been brutal to realize how much obviously it's hard to predict how much of a brutal market it's been for small caps and mid caps. To get valued at the lowest levels that they've been at since even lower at one point than 2008, the Great Recession, even though we're nowhere near the Great Recession. It's been brutal to see how low some stocks have been valued at, even with fundamentally good or brilliant performance. And it's been a situation that I thought I would only see if we ever got into a great recession again. But the fact that we're only in a bit of there's a few issues out there, and then these stocks get valued this low, it's like, wow, stocks can generally fall so much, and when you don't think they're going to go that low. So I think that's the other thing, is that how brutal the bear market can be on stocks, and even stocks that you think are doing absolutely amazing and financially performing so well, and how brutal it can be on them as well. So hope you enjoyed this video anyway, guys. If you could hit the like button, post anything down in the comment section that you feel like you want to share with the community as well. But yeah, have a great Sunday night, and I'll catch you in a bit tomorrow.